Ladies and gentlemen, welcome back to another episode of Investing for the Common Man, the channel that helps you save your most valuable resource. No, not your money, but your time. We just made it through the month of May, which focused on debates about when and how quarantines could be lifted and how businesses should be able to resume operations. The market rallied on several pieces of positive vaccine news, and we saw businesses and industries start to forecast what the coming 3 to 12 months will look like for local, national, and international commerce. With June just around the corner, I want to share with you the top 5 stocks that are on my watch list with some research and analysis to support my bullish sentiment. If you are skeptical of my picks, check out the recap video I posted yesterday about last month's stock picks that outperformed the S&P 500. Before we get started, please take a moment to hit that like button and subscribe to my channel so you don't miss any of my future watch lists. Alright, let's dive in. It is important to note that during the final week of May, we saw some rotation in the market with stocks highly exposed to the pandemic rallying strongly, while many tech stocks that had previously outperformed declined slightly. As the month of June begins, all eyes will be on how the country starts to reopen as businesses attempt to adapt and become profitable again. All 5 of my stock picks this month are companies that will either help with the reopening process or stand to benefit as people venture out of their homes and resume some of their standard spending practices. First off, we have Abbott Laboratories, ticker symbol ABT. If you've spent any time watching government press briefings, you have likely heard this company mentioned. Abbott is unique because they have developed a COVID-19 test kit that can deliver results in under 15 minutes, as opposed to the majority of tests that have been taking a full week for people to get back their results. This quick turnaround time, combined with the small size of the 6.5-pound testing machine, can allow these tests to be used in non-traditional places outside of hospitals and doctors' offices. It is possible that these 5-minute test kits might become the key to restarting industries that require close personal interaction between small groups of people, like professional sports leagues and television and movie production sets. Theoretically, with enough tests, you could screen each person daily and create closed systems in which people can work closely without fear of contracting the virus. This test kit was approved by the FDA about a month ago, and Abbott has been churning out about 50,000 test kits per day. Just this week, an article was published by the Press Herald detailing Abbott's plan to expand one of its test production plants in Scarborough by 20,000 square feet and expand and retrofit another facility in Westbrook to increase their test production capacity. If Abbott can successfully ramp up production to meet the demand of some of these major entertainment industries with deep pockets, I could see this stock having some significant upside in the next 1 to 6 months. Currently, the average analyst price target is about 10% above the current share price of $92, and the stock offers a dividend yield of about 1.7%. Next up, we have Moderna, ticker symbol mRNA. This stock absolutely skyrocketed last week, taking the entire market with it on news of promising results from its first phase of vaccine human trials. The company is compressing their trial schedule and beginning preparations of phase 2 testing while the phase 1 trials are being concluded. This accelerated timetable is exciting because it could mean that this vaccine gets fully tested and approved as soon as early 2021. Moderna is pursuing an mRNA vaccine strategy, which has big advantages over the more traditional viral protein vaccine methods, because scientists can skip the laboratory synthesis of proteins by directly injecting the molecular instructions for the human body to make those proteins itself. This makes mRNA vaccines cheaper and faster to produce, which could potentially make this vaccine the most scalable to combat a global pandemic. Now, all of this news is very exciting, but there are a few risks to investing in Moderna. This company is very young and has actually yet to sell a single product. That means that the company has no revenue and is currently relying on investor funding and research grants to fund these trials. There was also a lot of drama in the market right after this vaccine trial news broke because Moderna chose to issue more shares of stock, and several executives sold millions of dollars of their own stock, inducing accusations of insider trading. Because of these scandals, the stock has since dropped back down to the levels it traded at before the vaccine trial news announcement. This major pullback might offer a decent short-term buying opportunity for those that believe that Moderna could be the first company to produce a scalable vaccine that will help the entire world return to normal travel and commerce. While this company could be a risky long-term investment, since the company currently has no revenue and offers no dividend, I think that the downside risk from these current levels is muted in the near term until Moderna loses the vaccine race completely and COVID-19 is effectively eradicated. Even if you choose not to establish a position in Moderna, this is a very important company to keep on your watch list because it has significant power to affect the stock market as a whole. Moving on from the health technology stocks, I want to look at a few companies that have gotten slaughtered by the lockdown, but look like they will certainly survive and recover as people venture out of their houses and start spending money again. The first stock in this group that I want to look at is Starbucks, ticker symbol SBUX. Like most restaurants, Starbucks stock took a big hit, having to close down all of its stores around the world during quarantine. But I believe that Starbucks' road to recovery will be much faster than many, because a large portion of their sales are from takeout customers. As more and more people resume their daily commutes to work, picking up their morning coffee, Starbucks should see a steady uptick in sales. Not to mention pent-up demand and those fed up with trying to make their own coffee and cappuccinos at home. The stock is currently sitting just below this level of resistance around $79, so I'm going to be watching this one closely for a breakout above this level that could potentially become support. At its current valuation, Starbucks offers a respectable dividend yield of 2.4%. The next stock I want us to look at is Southwest Airlines, ticker symbol LUV. Like the restaurants, all of the airlines have been devastated by both government travel restrictions and low consumer demand from health concerns. Not to mention the whole group taking a beating after Warren Buffett sold off all of his airline holdings. At this point, almost all of the domestic travel restrictions have been lifted, but we might continue to see complications to international travel. Many countries are still enforcing travel bans, and even when those bans are lifted, it is likely that most travelers will have to self-quarantine for 2 weeks after arrival in a new country for the foreseeable future. Any quarantine period will suppress virtually all vacation and business travel, even if consumers feel comfortable flying. Southwest Airlines will likely outperform the other major airlines because of its relatively small exposure to international travel. Under its normal operating schedule, international travel only made up about 5% of their total flights. Many consumers might also be drawn to Southwest Airlines by their value pricing structure and the ability to choose your own seat as you board the aircraft, giving passengers a possible opportunity to social distance themselves or seat themselves with their traveling companions at no additional charge. Southwest's balance sheet is also much healthier than several other major airlines like American and United, so it is very unlikely that shareholders need to be concerned about bankruptcy risk. Southwest currently pays a dividend of about 2%, which has been steadily increasing over the last 5 years. Last but not least, I want to keep an eye on Carnival Cruise Lines, ticker symbol CCL. Cruise lines became the poster child for businesses affected by the pandemic with international scandals involving breakouts on ships like the Diamond Princess. Many expected the major cruise lines to go bankrupt, but all of them have been able to raise billions in capital to survive burning through cash for an extended period while operations are suspended. On May 12th, Carnival announced that it plans to resume sailing in August, pending CDC guidelines. The next day, cruise bookings jumped 600% over the same day last year before the pandemic. This shows that between enticing promotional offers and flexible cancellation policies, Carnival looks like they will be able to drum up demand and find people that are willing to sail once government restrictions are lifted, despite the health risk. Of the group, Carnival continues to be my pick because they had one of the healthiest balance sheets going into this pandemic and have not cut their dividend that yields almost 6% at current valuations. This stock and Southwest are both longer term plays, but I want to get into these names before they rally too far off their lows in anticipation of reopening. There are many skeptics about the reopening trade, myself included. I do not think that we are in for a sharper recovery as many originally thought, but I still find a prolonged recession doubtful. Because while there certainly have been many people hit hard by job losses and income disruption, I think that many consumers might actually have more disposable income than they are used to having. Between the unemployment insurance on steroids through the CARES Act, economic stimulus, low interest rates, and not to mention the tens of millions of salaried employees that have continued to work from home, retaining their same income while reducing their discretionary spending on restaurants, bars, travel, vacation, and concerts. All of these circumstances are things that simply were not present during the Great Recession of 2008, so it is difficult to use that economic crisis as a template for the very different situation that we find ourselves in today. If you have any questions or a favorite stock pick of your own, I'd love to hear it in the comments below. Don't forget to pick up your 2 free stocks from WeBull using my recommendation link in the description. I can see that several of you have opened an account, but you haven't deposited your first $100, which means you're missing out on your second free stock. Remember that you have 30 days to make that deposit, otherwise you'll forfeit your second free stock. I hate letting free money go to waste. Until next time, keep calm, stay healthy, and happy trading.